Now, before we continue with our discussion, let's take a quick look at another viewer's question we received. This one's from Dawn Mhlanga, and she asks, how does capital gains tax affect my insurance and investment portfolio? I think very, very important question, and one that we actually picked up at half time as well. And Harry, I'm going to give that one to you quickly.
Just how long have we got, Shaun? I mean, we can spend an hour on that.
I'll give you 2 minutes, I'll say.
You're generous. You see, what's interesting about investments is every investment has its own different CGT consequence. For example, if you own a unit trust, you sell those units in the unit trust, you pay CGT at your own personal rate, as Cheryl said, 10% maximum. If you have an endowment policy, then you wouldn't pay CGT directly in your own hands when you cash in that endowment, but within that portfolio, the insurance company pays CGT on your behalf, and that would be at 7.5% if you're an individual. So there's really a differential there between endowment policies and unit trusts.
Yes.
Shares, of course, you wouldn't pay any CGT on the dividends you receive, but you would pay CGT if you sold the shares.
On the capital appreciation.
On the capital appreciation, if there was anything like that. Now, as Cheryl was saying, what's interesting, it works both ways as well, because if you sell your unit trust and you make a loss, you can then get that loss and you can carry it forward into future years when you finally make a gain on other unit trusts and set the two off. In an endowment policy, if you sell units and you make a loss, that loss is really not going to be used by you. It's going to be going into the insurance portfolio, and they're going to make use of that loss in terms of their tax return. So, you know, a lot depends on your rates. If you're at a top margin rate of 40% and your CGT is therefore 10%, then you can see the endowment actually makes tax sense because you're paying then CGT at 7.5%. I hope that you viewers are following my figures. I'm showing them out quickly. Yeah. But an endowment would then actually bring down your CGT rate to 7.5%. Where if you're a low earning taxpayer, say you're below 300,000 Rand a year, so your top rate is 30% or below, then you'd rather be in a unit trust because then your CGT rate is below the 7.5% that an endowment's going to put you into. So CGT actually affects all your investments without people realizing it, because you shouldn't go into a certain investment. Again, I'm only purely looking at tax, without looking at the CGT consequences. Another point about a unit trust, which an endowment doesn't have, if you switch a unit trust, so you're in a linked product, you don't actually sell the units, you switch them. That's of course a deemed sale, and although you've got no cash in your pocket to actually show, you're now going to have to account to SARS at the end of the year for the gain you made on that switch. And we find a lot of our clients get hit very hard on that. They don't realize it's tax. They haven't got cash in their pocket because they suddenly switched from investing general equity to investing offshore, and next thing they have to pay tax on that notional gain, for want of a better word.
Yeah, but they haven't got anything to show for it in their back pocket.
Correct. Whereas in an endowment, it's so much easier because the insurance company pays the tax for you. You're still paying tax. It's coming out of your investment. It's been paid on your behalf by the insurance company.
Roland, that's such an important point, and I think you might be picking up on it as well, is that a lot of people talk about endowments being paying out free of tax, and at the end of the day, it's paying out post-tax.
After-tax money,
and capital gains tax is no sort of different. I think the one thing, to get to specifics on endowments, second-hand policies going to be very different, aren't they?
Second-hand policies, you effectively have a double CGT taxation. The taxation that Harry has just mentioned already happens within the actual portfolio while you're in the actual second-hand endowment. And that really just means because there's a change of ownership, you're now also going to have capital gains tax events when you actually dispose of that plan. So if you cash it in, surrender a portion of it, start taking monthly incomes from it, all of those events, every single time you withdraw from that actual plan, you will have another capital gains tax event as well. Now, very often we find that it's still a good tool to use because an individual has got their 17,500 Rand exemption each year. We find a lot of people can earn quite a substantial income using that exemption and still doing a lot better than being in a type of a policy where they're paying income tax on their full income. So there are definitely places for it, but obviously be aware that there are double taxations.
I think what we find is that some people buy second-hand endowments without needing that income.
Yes.
And then it's pointless. You know, just to have a second-hand endowment for the sake of it. You're paying a lot of extra tax for that privilege, and SARS has done that on purpose. If there's a particular need, I mean a widow or a trust-owned income, then a second-hand policy makes a lot of sense because you're taking away the income tax problem. But just to have it and have that double tax just for other reasons is not worth it. You've got to be very careful before you have a second-hand policy.
And just in terms of the rest of her portfolio, life insurance policies, those types of things are generally in a position where they are exempt from CGT. You'll find that there are the odd occasions, for example, if you have a keyman policy which a company owns, and you are the original life assured on the plan and the policy gets ceded back to you, it has to be a conforming policy, meaning that the company actually deducted the premium from tax. If that has happened, you can take it back, CGT free when it actually pays out. The only time that we really see big CGT events is on life policies, usually with a buy and sell kind of a situation in terms of business assurance. Reason being is because partnerships or owners in terms of a policy actually start changing around, and you'll find that there could be new owners coming into a business. And by just taking over that existing policy, immediately there's a capital gains tax event that will happen on the proceeds of the life cover. Everybody sort of thought in the beginning when it came out it would be on the cash value, but it's not. It's actually on the proceeds of the full life fund, and that's an important thing to remember.
Sorry, if SARS is listening, please can SARS look at changing that. It's great, such havoc. And what's interesting, sorry to interrupt, Raylan, I don't think SARS intend to get money on that kind of a policy because it's a pure life insurance policy. There's no investment, there's no anti-avoidance, but it slips into the net, unfortunately, and it causes havoc in our industry.
Yeah.
Because every time a new person joins, you have to redo the policy, and you have to keep redoing and redoing,
et cetera,
and it wastes money and it creates churn in the industry. So we're begging SARS every year now. We've been asking them to change one more.
You've come on TV to do the same. Fantastic. Cheryl, just quickly from your side, I mean, one of the things that I think a lot of people don't think about, we talk about an effective rate of a maximum of 10% for capital gains tax. Right. At the end of the day, if I've structured my tax affairs to pay the minimum amount possible, I then go into a unit trust type environment with 10 million rand as an example, that can actually bump up my entire taxable income, can't it?
Completely on that side, from the point of view that when you say bump it up, it will take it up to the marginal tax rate on that side, and as you say, it's a tax that people don't realize until such time as it actually hits them, on the basis that it could be within the insurance portfolios or the unit trust portfolio, as Harry said, and you don't necessarily have the cash flows for it, and the capital gains need to be included in certain of your provisional calculations, so therefore you've actually got those those negative cash outflows, and then it becomes a catch-22, because then you sell shares or unit trust to liquidate, to give you the liquidity to settle the taxes, and that in itself triggers a capital gains tax event. Yeah. So it certainly becomes a vicious circle from that point of view.
Yeah, absolutely. A big trend. We're almost out of time. A lot of people, especially a decade ago, were putting properties into companies and trusts and the like for the main reason of actually avoiding transfer duty. As we know, Transfer Duty Act has changed, taken that away, and in some events, many people are sitting at a higher capital gains tax rate than they would have had before if they just kept in their own names.
Sure.
Yeah. I mean, it's incredibly penal because you're actually going to hit on three different sides. First of all, if your property is in a company or a CC, you lose the 1.5 million rebate, as we discussed earlier. Yeah. Number two, your CGT rate in the company, as Cheryl said, is 14%, not 10% that would have been in your own hands. And number three, your money is then stuck in the company, and to get it out, you want to declare a dividend, and then you pay SDC. So you're actually paying an extra 24% tax, roughly, on property in a company or a CC. So if you live in it and you've got this opportunity now to unwind these companies and CCs, and there's a lot of technical issues you've got to look at, but assuming you can qualify, clients are advised to look at unwinding their companies or CCs. There's no benefit, as you've said, the transfer duty benefit's gone, and you've got this huge CGT penalty which sits there.
Yeah. Yeah.
Trust might be slightly different though, and you would urge clients to have a look at the trust scenario, in that the trust has got the added advantage that the capital appreciation on that property is trapped within the trust from an estate point of view. So in the event of the person dying before the property is sold, at least you've pegged the value from an estate side, bearing in mind though that as soon as the property is sold, capital gains tax will be triggered in the trust, and depending on the trust deed, the capital gain is either taxed in the hands of the trust, then at the 20%, or it could be vested or distributed to beneficiaries, and then fortunately taxed at a lower individual rate, but again you lose that 1.5 million rand primary residence exclusion.
But perhaps not even have to sell the property as well, and that's the thing, because it's not a death thing. You're not saying I'm not forced into selling this property, and we're not.
I think CGT and estate duty need to be looked at closely together and see which is best case scenario for our clients.
Yeah,
they go hand in hand.
As with most things, it goes by a case basis. I think we've hopefully covered the bare essentials of what it is and what capital gains tax means to most people. Cheryl, Harry, Raylan, thank you so much for your time tonight. I've certainly enjoyed the discussion, and I hope that the viewers out there have got something from our discussion. Before we go, it's time for a quick look at our weekly viewers' tips. This week, of course, our tips relate to the ins and outs of capital gains tax.
As you know, it's tax season, so don't forget to include your capital gains and losses into your tax return for all voluntary and involuntary disposals of assets. On a positive note, capital gains tax is not payable on personal use assets. If you've sold your primary residence for less than 2 million rand in the last tax year, then your gains will be free of CGT. Remember, you can only claim for one primary residence property which is less than 2 hectares. If you are married in community of property, then each spouse can claim a maximum exemption of 750,000 Rand from the 1.5 million exemption. If you have claimed income tax deductions on a home office, your 1.5 million Rand exemption will be proportionately reduced. Should your primary residence be in a trust, company or CC, you have an amnesty period until the end of next year to transfer your property into your own name without having to pay transfer duty, STC or dividends tax. Due to the introduction of CGT, many trusts have become redundant and expensive, with an income tax rate of 40% and an effective capital gains tax rate of 20%. With this being said, trusts still have their place, and if they are used correctly, make good financial sense. If assets are owned by a trust, there is no forced CGT event on the death of the founder. CGT only becomes payable on the disposal of an asset. However, it is important to remember a trust does not have exemptions like a natural person. One way to reduce tax payable in a trust is to distribute income and capital gains to natural beneficiaries in the same tax year that they accrue to the trust. This will mean that a natural beneficiary will pay their own individual tax rate at the maximum effective CGT rate of 10% instead of 20% in the trust. This can also work for a company or CC as a beneficiary, as the effective CGT rate is 14%. Insurance policies, including pension, provident and retirement plans, are exempt from CGT. The only time this exemption does not apply is if a policy has been ceded or if there's been a change of ownership. Second-hand policies fall into this category, which means that CGT is payable on the full disposed proceeds, whether it be an endowment plan or a life policy. Unit trusts and shares do not fall into this category, and all capital gains are taxable in the investor's hands. Even small estates, which are exempt from paying estate duty, could have a large CGT liability, which could leave your estate insolvent, leaving your family with nothing. By taking out a life policy for your estate, you can easily inject cash liquidity into your estate, which can easily alleviate the capital gains tax liability.